Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Dr. Michael Berry. Michael has, been a good friend of Michael's for a number of years now. We've been on various panel discussions and have been speakers at various events in Canada and the United States. He is a pioneer in the emerging field of discovery investing and really picks some very interesting investments using that theme. He researches and writes on companies that focus on natural resources, high tech, and biotech, so very diverse. And from 1982 to 1990, he was also, he was then in those days, a professor of investments at the Colgate-Darden Graduate School of Business Administration at the University of Virginia. During which time he published a book titled Managing Investments, A Case Approach. And, he's really had quite an experience also as an investment advisor. He was a fund manager for Heartland Advisors and Kemper Scudder. So, but he, along the way, decided that maybe academia wasn't where he wanted to be, because I think he sort of believed that maybe all that was being taught he couldn't in good conscience continue to spew forth to new young minds. So I really appreciate Dr. Berry's ability to break loose from the confinement of academia. Welcome, Michael. It's really good to have you with me again.
Well, Jay, it's great to be back with you again. It's a pleasure.
You know, your friend, Dr. Gary Shilling, who we've had on this show, very well-known economist. I hear him, or at least have in the past, heard him frequently on Bloomberg with Tom Keene and some of those guys. Very highly esteemed. He's a good friend of yours. He has been written, has written a book on deleveraging and on deflation. You and I have bantered around this whole issue of which way does this thing tip on an inflationary or deflationary direction. Shilling has been steadfastly a deflationist, and you indicated to me when I spoke with you the other day that you're sort of leaning in that direction too now. How so?
Oh, definitely. And, you and I have talked over the last decade or so. I've been on the fence, thinking that maybe the various QE programs that we've seen the Fed put into action would really give us some kind of sustainable growth in the world, and that has not happened. They've been failures. So what we see now is a huge debt overhang in the world, but particularly in the U.S. and Europe, and China is an unknown right now. But we know we know there are problems there. So I think that the Shilling's approach, which I'm beginning to really think holds sway here, is that the world has to deleverage, and there's another 4 to 5 to 6 years of deleveraging if we get after it today. That is, all debt has to be paid back, or it has to be in some way dealt with. And until we do that, we're not going to have sustainable growth. In fact, we're going to have declining prices. We're going to see what is traditionally called a shrinking market and lower prices. We're going to see savings rates go up. And I think that we're in the beginning phase of that kind of a cycle now. So I think there's several years left, and you see it in the commodities for sure. You do. So having said that, and I watched the money multiplier religiously, I study that, and I watched the velocity of money. When those things do turn, then we're going to have very high rates of inflation. So it's a double whammy that we're going through for the next 5 to 10 years, I think. And we're going to have to be quick on the trigger to take advantage of the situation.
Well, it's I'm glad you mentioned velocity of money, because I think that's a term that most economists, or you don't hear mainstream economists talk about money velocity very often, do you?
No, and when they do, no, you do not. When they do talk about it, basically it's the rate of circulation of the money supply.
Sure.
And there are many reasons why the velocity can fall. New technology is one reason, but basically we've seen it now declining for the last 8 years or so, quite significantly, and it's still in decline. And we know the banking system, because the multiplier has been now in decline for 74 months. We know that the money multiplier, the rate at which banks make loans, basically, is also declining. So, the fractional banking system isn't working. The base money supply has increased, but the money supply and circulation has not. And these are all signs to me that the economy is not, that sustainable growth is not possible in this economy, that it's slowing down. We see the two export economies, China and Germany, really struggling now. They do need exports. So you see this race to the bottom in the currencies, and they are exporting deflation as they knock their currencies down. And so, if you look at the world as now globally connected, you've got a really strong case for a deflationary environment, in my opinion.
Well, it seems to me, Dr. Berry, not that I was around then, I'm not quite that old, but the 1930s, you had what was defined as, a beggar thy neighbor environment where all the countries were trying to get a break by cheapening their currency and trying to cheat a little bit on their trading partners that way. You also had the phenomenon of money pumped into the system and it wasn't getting out, it wasn't being lent out, the pushing on the string analogy, which was drawn up in the 1930s. And you're seeing a hollowing out of the middle class and what Keynes talked about, the propensity to consume. It seems to me if there was one legitimate thing that Keynes had to say, I think that's one that I believe in. You put money in the hands of people that don't have any money and they'll go out and buy shoes for their kids and put food on the table. But the middle class, and I wonder about whether or not we're going to see any meaningful savings because the middle class has to take everything they get and spend it, and they have to get food stamps. The lower income level people, we're more food stamps than we've ever had before, almost I think in America. And it's this is not a good scenario for increasing demand. It seems to me, and let me know what you think about this, but it seems to me if we really had Keynesians that were concerned Keynesians about the society, they would be sending money out to the lower income groups, and they would stop bankrolling the rich and the powerful. What do you think?
Well, I think you're right on target here, Jay. The very small proportion of the economy that's wealthy is getting much wealthier, much stronger, and they do spend, but it's a very small proportion.
Right.
And then the rest of the economy, probably 80%, is being made into middle and lower middle class, and they're not getting the per capita wage, real wage gains that we've seen for years and years and years. That's not happening. So I think that the issue is one of austerity. It's happening to a very large proportion of this economy, and this economy in the United States is 70% consumer-driven. It's not like Germany or China. It's 70% consumer-driven, and that's a big problem. So this government, this Federal Reserve, and this government wants the American consumer to consume, and I think we're seeing that slow down now. This is the season of buying gifts, and so it's hard to measure it in November and December, right after Thanksgiving. But I think we're seeing impoverishment. We're seeing zero interest rates that really hurt senior citizens, and there's a large proportion today of baby boomers that are going through this process. And so basically, this very small proportion of the rich are getting richer, and the rest of the economy is getting is being more impoverished. And that's a problem for the U.S. economy, and it's a problem for the world.
No question about it. I want to know, though, we're seeing this decline in the consumption, the ability to consume, but clearly it seems to me the more the government gets involved in manipulating interest rates or what have you, in the short term maybe there's some brief relief, but longer term it just seems to create bigger problems. What are you discovering in your discovery investment quest for finding new ideas? Are there some that you'd like to share with our listeners?
Well, I think one right off the top it wasn't my discovery, but if you look at a shale oil development, you have to believe that has revolutionized the energy industry. Now, there are a lot of complaints about fracking or hydraulic fracturing of the earth, but basically it will make us energy independent here. And so what I'm seeing in that sector, Jay, are all kinds of improvements to what we call fracking of all kinds. They're going from 160 acres a well to 40 acres a well. They're going from the top of the zone to the bottom. There are all kinds of productivity improvements coming in, company by company, and those are the kinds of what I call what Chris and I, my son and I, call disruptive discoveries. And they're very, very interesting, and they're having a huge impact. I heard your conversation with Chen on oil. This is a huge impact on the energy world and a huge impact on our deficit and what we have to do in this country. So there's a lot of opportunity to be made in the Eagle Ford Shale in Texas, for instance. People have bemoaned the fact that, these kinds of discoveries, tail off very quickly, but the fact is the technology is moving ahead in these areas. So I'm looking at those things. And I'm also looking at some things like plasma torch technology for processing of minerals. It's not quite here yet, but it's going to be soon, and it has the potential to revolutionize how we extract minerals from the earth. So those are a couple of things that we're dealing with now.
Okay, Michael, let me ask you this. You are working with your son, Chris, now. Chris was working with you. Do you still put out your missives from time to time?
Yes, yeah, we do. It's morning notes, and Chris and I write maybe once a week or so now. I used to write every day, as you remember, Jay, and
yes.
Now we're much more selective in what we write about. Some of the interesting things we're seeing now are, for instance, there's some things happening in the zinc market that are really, really interesting. There are some big discoveries in Mexico now in the mining sector, but this is the toughest market I have ever seen for exploration and discovery and development companies in mining.
Okay, well, let me ask you just a second. Let me ask you, how can people avail themselves to that, to your morning notes?
Simply going to Discovery Investing. One word, Discovery Investing.
Discovery Investing. Okay, very good. And you can put the name on the list and get your missives sent out to you that you and your son work on. Let me ask you, getting to the issue of deflation. It certainly is not a bad thing for the mining industry necessarily, especially in a deleveraging age. When you have, Bob Hoy has done work along these lines. If you go back and look at whenever we've had major deleveraging taking place, you've also seen profits rising in the mining sector, 1930s, for example, and we saw it briefly after the 2008-2009 situation. Are you seeing? So far it hasn't played out with oil dropping, but I'm starting to see some revamped and upward revisions in the estimates that some of the analysts are making for some of the major gold mining companies. What are your thoughts along those lines? Any good news for gold miners?
Yeah, I think there's some. I think Jay, I have to tell you, I was managing money for Heartland Advisors. You mentioned in 1999, and oil went to $12 a barrel. So where the price goes is not necessarily related to value. I learned that the very hard way. But what I'm seeing is that a lot of the mining companies that are over-levered now are shucking off their properties that aren't going to make it. So there's a lot of opportunity out there in the sector for properties that are becoming available. And several of the big mining companies are really struggling. I think Barrick is one of them that's struggling, for instance.
Yeah.
Goldcorp is one that has a fairly clean balance sheet, so it's not struggling to the extent. So I agree with Chen. I think when we were at 1140, we were really close to a bottom in gold. So, and at $15 silver, we were 100 million ounces short of silver supply the last 2 years, in total of the last 2 years. So pretty soon what you see is exploration and development stops. And when that happens, this is a reflexive action that forces the price of the commodity back up. Let me also point out that, as you know, the Senate last week published a 400-page report suggesting the top four banks had a significant hand in manipulating and showed some of the issues in manipulating the commodity markets. And I think you're going to see some action on behalf of the Congress to try to rein in these too big to fail partners in the commodity market. So I think overall this thing has a chance to bottom and to move up. I think it's too cheap here.
All right, Michael, I'd like you to stay with us. I've got David Jensen with me now, and I think it's a good time to bring him in with the last 8 or 9 minutes we have left for today's show. But when you talk about market manipulation, David Jensen has been watching some dynamics in the gold market that I think are extremely important. And as we were talking to Chen a little earlier, we think that we could be on the cusp of a breakout here above $1,200. David, are you with me now? Can you put David through?
I'm here.
Oh, David. Hi, David. Yeah, so it was we were just talking to Michael Berry, and he was mentioning the manipulation, and the Congress is looking after some of these issues. I'm not so sure that I'm as optimistic as Dr. Berry is that the Congress is going to do anything meaningful, but I do think there's some very interesting market dynamics that are going on that you've brought to my attention and to our listeners' attentions, and I'd like you to just update us a little bit on some of these things. David, primarily we're looking at the 1-month lease rate, which is really rising very dramatically, and also the GOFO rate. Would you care to address those issues for our listeners? And then, Michael, perhaps a comment from you before we conclude the show, if you're still with us. Go ahead, David.
Yeah, sure, Jay. Just a quick note here on the size of the gold market. It's about 160 million ounces a day, or almost 200 billion ounces a day trading versus only 50 million on the New York Stock Exchange for the daily trading of shares. It gives you an idea of the scale, because everybody says the gold market is so much smaller than the other markets, and meanwhile it's 4 times as large. But on the lease rate and the GOFO, we're seeing the lease rate now spike up to only the 1-month lease rate spiking to within 2 basis points of the 1-year lease rate. And we don't see another example of that going back many, many years in the data. And that's indicating that there is an extraordinary demand for gold, for physical gold, in the market. The typical spread between those two is about 30 basis points. So it gives you an idea. It's gone from 30 basis points down to just 2 basis points. And the 1-month lease rate has spiked above the 2, 3, and the 6-month lease rates. So people want this in the most liquid market, the 1-month lease rate market, and they want it now. The GOFO has also been spiking negative. The GOFO represents LIBOR minus the lease rate, and that has now spiked strongly negative in the 1 month through to the 6-month lives. Now, what is interesting about that is that the 6-month GOFO rate has spiked down now for 8 days negative, and it's plunging almost straight down.
Yes.
And going back to before 2000, we cannot see another example of 8 days. I mean, in early spring of 2014, there was 3 one-day spikes down in the GOFO rate into the negative, but now it's been 8 days sustained on the 6-month basis. So, and as I mentioned, the 1 month has been negative now for 22 days. So the physical market, I like the lease number. It's the most intuitive to follow. The lease rate is showing the demand for physical gold in hand, and that has the spiking of it and the inversion of the 1 month above the 2, the 3, and the 6 month is, I think, really notable for your listeners.
Mm-hmm. Well, it seems to me also when you speak of the GOFO rate, as I understand it, it's telling us that people are willing to pay more to borrow gold for 1 month than they're willing to pay to borrow dollars for 1 month with the LIBOR rate. Isn't that correct?
That's right. It reflects the GOFO is equal to LIBOR minus the lease rate. So when you've got a negative number there, it means that leasing out gold is yielding more than lending out U.S. dollars, and that should theoretically not be possible because of the costs associated with holding gold. So the costs are not relevant at the margins here. It's the fact of actually getting the gold and holding the gold, which is desired by the market.
I guess we can only speculate as to where this demand is coming from, and what some of the dynamics behind that demand might be. But it certainly seems to me we have growing geopolitical issues around the world, primarily the BRIC countries versus what I call the Anglo-American Empire. We have Putin telling Russians they have 1 month to get rid of their to get rid of their dollars. Where are they putting those dollars? I would guess maybe some of it is making its way into gold. I think one of the people you and I know that has been mentioning there is a connection between the timing of the Shanghai market when it went international or when it opened up for trading, and also this lease rate. Could you care to talk about that and maybe speculate a little bit on where this demand might be coming from? Demand for physical
Sure.
as opposed to the casino chip gold that I like to call in the COMEX.
Yeah, we don't know. It's a virtual market. There's many overlapping layers. As you mentioned, Luke Grauman there from our discussion group, he noted that the bottom in the lease rates was within 2 days. It was September 16, and on September 18th, the Shanghai Gold Exchange International Board opened up. So we don't know if that's a factor. There are probably many factors at play here. I think that the Swiss Gold Initiative, the referendum on that on November 30th, could be playing into it. We really don't know. It would make sense that if there's going to be a sudden demand for gold, that those who could owe out physical would want to be holding it, so that they could deliver under their contract. So we really don't know, Jay. It's just so many different things. Greenspan's commentary about gold being the preeminent currency as well. There's half a dozen or more, and it's very difficult to say. But what we do know is that physical gold is in demand, and the price in what we call the virtual market on the LBMA and in New York is not responding.
Yeah, I think it's very interesting that Greenspan reiterates the importance and the lack of confidence in currencies and fiat money over time in front of the Council of Foreign Relations, no less. Very, very interesting forum for him to make those remarks. Michael, any comments? We got another couple of minutes or so. Anything you've heard David say that you might want to comment on?
Well, my knowledge is that the Chinese are buying gold. They're buying all the gold I believe they bought all the gold that was produced last year.
Yeah.
So I think that's one thing. And secondly, is sooner or later the paper markets are the tails that wag the dog. I happen to know this. I had a debate with Jeff Christian on this issue in Spokane a few weeks ago, and sooner or later these guys are going to have to get out of their short position, and I think that's going to happen. I think the Swiss thing is of interest, but that the Fed contacted me and said we want 3 seminars next year from me. And we want it on interest rate volatility. So so I think if they're looking at interest rate volatility, I think that bodes well for the price of gold, actually. And I think we're going to see more volatility in the interest rates as well as we go down this road. So it wouldn't surprise me to see. I don't think we're going to see $2,000 or $3,000 gold in the short term because of the deflationary aspect of the economy, but I think we're going to see higher gold. And I think that will save a number of the players in the gold mining industry.
Well, and indeed, in my way of thinking, and as I look at mining companies, it's the real price of gold that matters even more. And as I think history sort of points out, that during deflationary, and when you have a deleveraging deflationary environment, that is very bullish for gold if the cost of getting the stuff out of the ground is falling relative to the price. We're out of time, unfortunately. Never enough time with you guys, and I want to thank both of you, David and Michael, for being with us today.